3 rate cuts, in a single year. A surprise 50 basis point cut suddenly on the table. And some analysts are even calling for Bitcoin to double before Christmas. Sounds insane, right? Well, by the end of this video, you'll know exactly what's signal, what's noise, and how to position before the rest of the market even realizes what's happening. I promise, this is one of those videos you'll want to watch all the way through, because we're not just talking about what the Fed might do. We're talking about how it could set up one of the biggest wealth shifts we've seen in decades. Today we're diving into what could be the start of a massive rate-cutting cycle, why it matters for stocks, crypto, and your wallet, and why the next Fed decision might completely flip the script for 2025. Before we get started, quick question for you. Drop it in the comments. Do you think the Fed goes with a 25 basis point cut, or do you believe they'll shock the market with a 50? Just put 25 or 50 down below, and let's see where this community really stands. Let's start with the big picture. Outside the US, the cutting cycle is already underway. In fact, there have been 88 rate cuts worldwide this year alone, the fastest pace since 2020. Think about that. Nearly every major economy is trimming rates to try and stimulate growth. Canada has already moved. The European Central Bank has cut. Smaller economies across Asia and Latin America? Same story. And here's the wild part. Bank of America says 2025 is shaping up to be the third fastest global cutting cycle on record. Liquidity is coming back into the system worldwide, whether we like it or not. The US, of course, is the outlier. The Fed has been stubbornly holding rates high, waiting for inflation to cool further. But with jobs data weakening, consumer sentiment dipping, and global peers cutting, the US can't stay frozen forever. So the real question is not if the Fed cuts, but how aggressively. Now here's where it gets interesting. The odds of a monster 50 basis point cut in September, just days from now, have quietly crept into double digits. A week ago, the probability was around 6%. Now it's over 10%. If this jumps to 15 or 20% before the FOMC meeting, the market will start pricing it in fast. Why does this matter? Because a 25 bits per second cut is expected, boring, safe. A 50-point slash would be like the Fed firing a flare gun into the sky. It would shock the system, push equities higher in the short term, and pour gasoline on the crypto fire. And let's be real, the Fed has pulled this move before. Skip July, then come in with a jumbo cut in September. It wouldn't be the first time. Economist Mohamed El-Erian put it bluntly, the Fed's been too narrow in its focus, looking only at headline job numbers while ignoring weakness bubbling under the surface. He argues the Fed should have cut in July. By waiting, they're risking a harder landing for the economy. And yes, they can catch up with a big cut now, but it's risky. Think of it like surgery. You can fix the problem late, but the longer you wait, the more complicated and dangerous the procedure becomes. And here's the kicker. Even if capital gets cheaper, will companies use it to hire people, or to pour into automation, AI, and robotics? That's the structural risk nobody wants to talk about. Cheaper money doesn't always mean more jobs, it might just accelerate the replacement of jobs. On the flip side, some analysts are scratching their heads. They're saying, why cut rates at all? Credit spreads are tight. Stocks are at or near record highs. Tech valuations are euphoric thanks to the AI boom. Historically, the Fed only cuts when markets are under stress. Right now, financial conditions are incredibly loose. They're warning? Cutting in this environment risks fueling bubbles, just like in the late 1990s, or even parts of 2021. But here's the counter. The Fed's job isn't to babysit the stock market. Their mandate is twofold: price stability and maximum employment. And if the labor market is weakening, that mandate forces them to act, even if Wall Street looks fine. Let's rewind for a moment. From 1995 to 2000, the S&P 500 racked up dozens of all-time highs in a row, over 70 in 1 year alone. It felt unstoppable, until the dot-com bubble burst and $7 trillion in wealth evaporated almost overnight. Fast forward to today. Are we seeing the same thing? Not quite. Our run of all-time highs isn't at dot-com levels, but the liquidity cycle, the tech narrative, and the concentration of capital among the wealthy rhyme with that era. History doesn't repeat, but it does echo. We're either at the beginning of another multi-year melt-up, or sitting on the edge of a cliff. And this is where crypto enters the story. Digital assets are hypersensitive to monetary policy. When the Fed paused for 9 months this year, Bitcoin stalled. But here's what Tom Lee pointed out. In easing cycles, especially when they begin in September, risk assets, including crypto, tend to run hard into Q4. He even went as far as to say Bitcoin could hit $200,000 by year's end. That's almost a double from current levels. Aggressive? Sure. Impossible? No, when liquidity floods in, crypto doesn't move slow, it rips. Ethereum, with its links to small caps and its role in stablecoins and tokenized assets, could ride that same wave. Ethereum's fundamentals quietly keep improving. Stablecoin supply on ETH has hit a record $165 billion. Tokenized treasuries and gold are at all-time highs. More companies are experimenting with crypto treasuries, literally holding ETH and Bitcoin on their balance sheets. This isn't hype, this is infrastructure. And in a world where trillions in assets are slowly migrating onto blockchain rails, Ethereum sits at the center. So how do you prepare? Here's my 5-step Q4 playbook. Plan for both 25 and 50 bits per second. Don't guess. Scenario plan your trades before the FOMC. Respect liquidity. When money gets cheaper, assets run hot, but pullbacks can be brutal. Track jobs data. Weak prints mean more cuts, but also higher recession risk. Stagger entries. Scale in and out. Don't go all in on headlines. Secure your base. Take profits when offered. Keep dry powder. Avoid reckless leverage. Remember, narratives travel faster than spreadsheets. Plan the trade, then trade the plan. Alright, your turn. Drop a comment. 25 or 50. What do you think the Fed does next? And tell me your Q4 allocation strategy. BTC heavy, ETH plus small caps, or defensive until cuts? Smash the like button if this helped clarify the madness. Subscribe if you haven't already, and join my free newsletter. The link's down below, for my post-FOMC checklist. Stay sharp, stay nimble, and I'll catch you in the next video.